Why are there so few billionaires in the world? With millions of investors, thousands of hedge funds, and decades of bull markets, why are billionaires so rare? The answer will shock you. It is not lack of opportunity. It is not bad luck. It is poor decision-making. Most investors destroy their wealth through simple, preventable mistakes. Victor Haghani and James White spent decades on Wall Street. They managed billions. They witnessed fortunes made and lost. Their book, The Missing Billionaires, reveals why smart people make terrible financial decisions. In this video, you will discover the mathematical secrets of wealth building. You will learn why diversification saves fortunes. You will understand position sizing that prevents ruin. Most importantly, you will avoid the mistakes that keep billionaires missing. This is not theory. This is practical wisdom from the world's top financial minds. Stay focused, because one concept here could save you millions. Let's discover why billionaires are missing and how you can avoid becoming one of them. Chapter 1. The Missing Billionaires Paradox. The title question is profound. Where are all the billionaires? Statistically, there should be far more than exist today. Victor Haghani and James White explain the paradox mathematically. If investors made optimal decisions, compound growth would create thousands more billionaires, but they do not exist. They are missing. Consider this scenario. Start with $1 million. Achieve 15% annual returns for 40 years. You would have over $260 million. Not quite a billion, but substantial. Now increase returns to 20% annually. Same 40-year period. You would have nearly $1.5 billion. A billionaire. This is mathematically achievable. Many investors have access to such returns. Yet billionaires remain rare. Why? The answer is behavioral mistakes. Investors sabotage themselves. They take excessive risk. They panic during downturns. They make emotional decisions. The authors share a powerful insight. Survival is prerequisite for success. You cannot compound wealth if you go broke. Ruin is permanent. Recovery from zero is impossible. Most investors optimize for returns without considering risk of ruin. This is catastrophic error. Maximizing returns without protecting downside guarantees eventual destruction. Think about gambling. A gambler winning consistently still goes broke eventually if bet sizing is wrong. One bad bet at wrong size ends everything. Investing is similar. The Kelly criterion provides mathematical framework. It calculates optimal bet size, balancing growth and safety. Most investors ignore this. They bet too much. Ruin follows inevitably. Haghani and White emphasize that missing billionaires destroyed themselves. They had winning strategies. They had capital. They had opportunities. But poor decision-making eliminated them. Leverage is primary destroyer of wealth. Borrowed money amplifies gains, but also losses. Many brilliant investors have been wiped out by leverage. Long-term capital management is a classic example. LTCM had Nobel Prize winners, sophisticated models, decades of experience. They collapsed in months because of excessive leverage. Genius is no protection against ruin. Concentration is another killer. Putting everything in one investment creates massive risk. Even if the investment is good, unexpected events destroy concentrated portfolios. Lack of diversification means one mistake is fatal. Enron employees had retirement savings in company stock. When Enron collapsed, they lost everything. Concentration risk destroyed them. Behavioral biases compound problems. Overconfidence makes investors take excessive risk. Recency bias causes chasing past performance. Anchoring prevents cutting losses. These biases are wealth destroyers. The authors argue that financial education focuses on the wrong things. Schools teach about returns, not risk management. They teach asset selection, not position sizing. This creates dangerous knowledge gaps. Understanding compound growth is essential. Einstein called it the eighth wonder of the world. Small differences in returns create enormous wealth differences over time. But understanding compound losses is equally important. Losing 50% requires 100% gain to recover. Asymmetry of gains and losses is a critical concept. The Missing Billionaires made preventable mistakes. They optimized wrong variables. They ignored fundamental principles. They let emotions override mathematics. Your goal is avoiding their fate, learning from their mistakes, implementing principles that preserve and grow wealth. This journey starts with understanding what went wrong. The paradox is solved through proper decision-making. Billionaires are not missing because opportunity lacks. They are missing because decision quality is poor. Improve decisions. Build lasting wealth. This book provides the framework. Mathematical principles combined with behavioral awareness. Together, they create the foundation for superior financial outcomes. Master both, avoid becoming a missing billionaire. Chapter 2. The Power of Expected Value. Expected value is foundation of all good decisions. Understanding this concept transforms decision-making quality, yet most people ignore it completely. Victor Haghani and James White explain expected value simply. Multiply each outcome by its probability. Sum the results. This is expected value. Compare expected values to choose optimal decisions. Here is an example. You can invest in two opportunities. Investment A has 50% chance of making $10,000 and 50% chance of losing $5,000. Calculate expected value. 50% times 10,000 equals 5,000. 50% times negative 5,000 equals negative 2,500. Sum equals 2,500 positive expected value.
B has 20% chance of making 50,000 and 80% chance of breaking even. 20% times 50,000 equals 10,000. 80% times 0 equals 0. Expected value is 10,000. Investment B has higher expected value despite lower probability of success. This is counterintuitive. Most people prefer investment A because 50% success feels safer, but mathematics favors investment B. Expected value thinking applies everywhere. Career decisions, business opportunities, investment choices. Always calculate expected value. It reveals optimal path. But expected value alone is insufficient. You must also consider risk of ruin. High expected value means nothing if one outcome bankrupts you. Survival always comes first. The authors introduce concept of utility. Money has diminishing marginal utility. Your first million is more valuable than your 10th million. Your last 10,000 is more valuable than your first 10,000. This affects decision-making. Risking half your wealth for 50% chance of doubling is poor decision, even though expected value is positive. The utility of losing half exceeds utility of gaining half. Risk aversion is rational. Contrary to what aggressive investors claim, avoiding disproportionate risk is mathematically sound. Protecting downside is not weakness, it is wisdom. Haghani and White discuss prospect theory. Humans feel losses more intensely than equivalent gains. Losing $1,000 hurts more than gaining $1,000 feels good. This is psychological reality. Understanding this asymmetry improves decisions. Take risks where potential gains significantly exceed potential losses. Avoid risks where gains and losses are similar. Asymmetry is your friend. The concept of optionality is powerful. Creating situations with unlimited upside and limited downside generates wealth. Entrepreneurship has this quality. Starting business has capped loss but potentially unlimited gains. Conversely, avoid negative optionality. Unlimited downside with capped upside destroys wealth. Short selling has this quality. Maximum gain is 100%. Maximum loss is infinite. Asymmetry works against you. Diversification increases expected value while reducing risk. Counterintuitive, but true. Multiple uncorrelated bets with positive expected value outperform single concentrated bet. Mathematics proves this consistently. The authors emphasize that expected value thinking requires honest probability assessment. Wishful thinking destroys decision quality. Be brutally realistic about probabilities. Optimism is expensive in decision-making. Study base rates. What percentage of startups succeed? What percentage of day traders profit? Base rates provide reality check. Most people ignore them. This is a costly mistake. Update probabilities with new information. Bayesian thinking improves as data accumulates. Flexibility in belief updating is crucial. Stubborn attachment to initial estimates costs money. Expected value thinking feels cold and mathematical. It is. Emotions have no place in financial decisions. Mathematics is objective. Feelings are subjective. Trust mathematics over feelings. Practice expected value calculations daily. Small decisions provide training. Which route to work? Which restaurant? Calculate expected values explicitly. This builds intuition. Over time, expected value thinking becomes automatic. You intuitively sense when opportunities have positive expected value. This intuition is built on mathematical foundation. It is reliable. The Missing Billionaires ignored expected value. They made decisions based on gut feelings, emotions, stories. These are unreliable guides. Expected value is reliable. Implement expected value framework immediately. Before every financial decision, calculate expected value explicitly. Write it down, compare alternatives, choose highest expected value option. This one concept, properly applied, dramatically improves financial outcomes. Expected value is not everything, but it is foundation. Master it before moving to advanced concepts. Chapter 3. Kelly Criterion and Optimal Bet Sizing. The Kelly Criterion is most important concept in wealth management. It determines how much to risk on any opportunity. Understanding Kelly prevents ruin and maximizes growth. Victor Haghani and James White explain that John Kelly developed this formula in 1956. It calculates optimal fraction of capital to bet based on edge and odds. The formula is simple. Kelly percentage equals edge divided by odds. Edge is your advantage, odds are potential return. Result is percentage of capital to allocate. Here is an example. You have investment opportunity with 60% chance of success. Success doubles your money. Failure loses your investment. Should you invest? How much? Calculate edge. 60% chance of doubling minus 40% chance of losing everything. Expected value is positive. Invest. But how much? Kelly Criterion says bet 20% of capital. Not more, not less. 20% balances growth and safety. Betting more increases ruin risk. Betting less sacrifices growth. Most investors bet too much. They allocate 50, 70, even 100% to single opportunities. This is suicide. One bad outcome destroys them. Missing Billionaires bet too much. The authors emphasize that Kelly is theoretical maximum. Real-world implementation requires caution. Most experts recommend half Kelly or quarter Kelly. This provides margin for error. Why fractional Kelly? Because estimating edge is difficult. Probabilities are uncertain. Kelly assumes you know exact probabilities. You never do. Fractional Kelly accounts for uncertainty.
Kelly means betting half the Kelly recommendation. This reduces return slightly, but dramatically reduces ruin risk. The trade-off is worthwhile. Survival trumps optimization. Haghani and White share research showing half Kelly outperforms full Kelly in real-world conditions. Estimation errors and volatility make half Kelly more robust. This is crucial insight. Kelly criterion applies to portfolio construction. Each position should be sized according to Kelly. High-conviction ideas get larger allocations. Low-conviction ideas get smaller allocations. Never allocate more than Kelly recommends. This violates mathematical optimization. It increases risk without increasing expected returns. Overbetting is pure loss. Underbetting is acceptable. It reduces returns but also reduces risk. Conservative investors can use quarter Kelly or smaller. This still provides growth while ensuring safety. The beauty of Kelly is that it compounds optimally. Over time, Kelly sizing produces highest median wealth. Not highest possible wealth, highest median. This distinction matters. Someone using Kelly will never have the absolute highest return. Aggressive bettors occasionally get lucky and achieve higher returns, but most aggressive bettors go broke. Kelly maximizes long-term success probability. Implement Kelly by calculating it explicitly for each investment. Estimate probability of success. Estimate payoff ratio. Apply formula. Use result as maximum allocation. Then apply fractional Kelly based on confidence. High confidence in estimates? Use half Kelly. Uncertain estimates? Use quarter Kelly. Always err on the side of caution. Rebalance positions as values change. Winners grow beyond Kelly allocation. Trim them. Losers shrink below Kelly allocation. Add to them if thesis remains intact. Systematic rebalancing maintains Kelly optimization. The authors warn against ignoring Kelly. Many investors know the formula but ignore it. They bet too much on high-conviction ideas. This is irrational. Mathematics overrides conviction. Kelly criterion is not intuitive. It feels too conservative. High-conviction opportunities tempt overallocation. Resist this temptation. Kelly is correct. Intuition is wrong. Historical examples prove Kelly's power. Warren Buffett essentially uses Kelly. He sizes positions based on conviction and odds. He never bets the farm. Kelly thinking made him wealthy. Conversely, aggressive hedge fund managers who ignore Kelly eventually blow up. They might outperform for years, but ruin is inevitable. Leverage and overallocation guarantee destruction. Study Kelly deeply. Read academic papers. Understand mathematical derivation. Intuition follows understanding. Once you grasp why Kelly works, following it becomes easier. Practice Kelly on small decisions. Sports betting provides excellent practice. Calculate Kelly for various bets. Compare results to alternative strategies. Experience teaches powerfully. The Missing Billionaires ignored Kelly. They bet too much on good opportunities. Good opportunities with bad sizing still destroy wealth. Kelly prevents this fate. Implement Kelly immediately. Calculate current portfolio allocations. Compare to Kelly recommendations. Rebalance aggressively. This single action dramatically improves long-term outcomes. Kelly criterion is your protection against yourself. It prevents overconfidence from destroying you. It enforces discipline mathematically. Trust Kelly. It is smarter than you.
Diversification as risk management. Diversification is the only free lunch in finance. It increases returns while reducing risk. Yet many investors resist it. This resistance is costly. Victor Haghani and James White explain that diversification works through correlation. Uncorrelated assets move independently. When one declines, others do not. This smooths returns. Perfect diversification requires many uncorrelated positions. Research shows 15 to 20 positions eliminate most idiosyncratic risk. Beyond 20, additional diversification provides diminishing benefits. But positions must be truly uncorrelated. Owning 20 tech stocks is not diversification. They move together. True diversification requires different sectors, geographies, and asset classes. The mathematics is compelling. Portfolio of 20 uncorrelated assets with identical expected returns and volatility has same expected return as single asset, but volatility drops 75%. Lower volatility with same returns is superior. It allows larger position sizes via Kelly criterion. Higher position sizes with lower risk produce higher long-term growth. Diversification literally increases wealth. Many investors believe diversification reduces returns. This is false. Diversification reduces volatility, not returns. Lower volatility enables higher geometric returns through compounding. Haghani and White share example. Two portfolios. Portfolio A has one stock returning 20% annually with 40% volatility. Portfolio B has 20 stocks, each returning 20% with 40% volatility, uncorrelated. Both have 20% expected arithmetic return, but Portfolio B has higher geometric return due to lower volatility. Over decades, geometric return is what matters. Portfolio B dramatically outperforms. The authors emphasize that concentration is glorified unnecessarily. Warren Buffett's concentrated approach works for him. He has extraordinary skill and permanent capital. You probably do not. Concentration without his advantages is dangerous. Even Buffett diversifies more than people realize. Berkshire Hathaway owns dozens of businesses. Within public equity portfolio, he holds 15 to 20 positions. This is reasonable diversification. The myth of concentration creating wealth ignores survivorship bias. A few concentrated investors became wealthy. Thousands went broke. You only hear about survivors. This creates false impression. True wealth preservation requires diversification, multiple positions across multiple asset classes, stocks, bonds, real estate, commodities, businesses. Spreading wealth protects against unforeseen disasters. 2008 financial crisis demonstrated diversification value. Stocks crashed, but bonds rallied. Balanced portfolios suffered less. Recovery was faster. Concentration in stocks or real estate was devastating. The authors discuss correlation risk. Assets uncorrelated normally become correlated during crises. Everything drops together. This reduces diversification benefits when needed most. Mitigation requires diversification across truly independent return drivers: equities, fixed income, inflation hedges, alternatives. Maximum separation reduces correlation during stress. Geographic diversification matters. U.S.-only portfolios concentrate political and economic risk. International exposure provides true diversification. Currencies, regulations, economic cycles differ. Sector diversification within stocks is essential. Technology, healthcare, finance, consumer, energy, utilities. Different sectors respond differently to economic conditions. Spread across sectors. Asset class diversification provides greatest benefit. Stocks, bonds, real estate, commodities, private equity, hedge funds. Minimal correlation across asset classes stabilizes portfolios. Haghani and White warn against false diversification. 10 mutual funds all holding the same stocks provide no diversification. Holdings matter, not number of accounts. Review actual portfolio holdings. Aggregate everything. Look for overlaps. Eliminate redundancies. Ensure true diversification exists. Rebalancing maintains diversification. Winners grow disproportionately. This concentrates portfolios over time. Systematic rebalancing sells winners and buys losers. This enforces discipline. Emotional resistance to diversification stems from regret aversion. Selling winners to buy losers feels wrong, but mathematics proves this optimal. Override emotions with systematic rules. The Missing Billionaires concentrated excessively. They believed diversification was for cowards. They wanted maximum returns. Concentration gave them maximum returns temporarily, then it destroyed them. Implement diversification today. Assess current concentration. Identify correlated positions. Reduce overlaps. Spread across sectors, geographies, and asset classes. Diversification feels boring. It will never generate the best return in any period, but it will generate consistently good returns over all periods. Consistency builds wealth. Trust mathematics over instinct. Diversification is proven optimal strategy. Concentration is proven destroyer of wealth. Choose mathematics. Protect your future. Diversify properly. Chapter 5. Leverage, the double-edged sword. Leverage amplifies returns and risks simultaneously. It is the most dangerous tool in finance. Used properly, it accelerates wealth. Used improperly, it guarantees destruction. Victor Haghani and James White dedicate significant attention to leverage. They have seen brilliant investors destroyed by it. Understanding leverage is survival skill. Leverage means borrowing money to invest. If you have $100,000 and borrow $100,000 more, you have 2-to-1 leverage. Your portfolio is $200,000 with $100,000
Suppose investments gain 20%. Portfolio increases to $240,000. Repay loan of $100,000. You have $140,000. 40% return on your equity. Leverage doubled returns. But suppose investments decline 20%. Portfolio drops to $160,000. Repay loan of $100,000. You have $60,000 remaining. 40% loss. Leverage doubled losses. Asymmetry makes leverage dangerous. 20% gain becomes 40%, but 20% loss also becomes 40%. Volatility increases linearly with leverage. Worse, losses compound. 50% loss requires 100% gain to recover. With leverage, smaller declines create larger losses. Recovery becomes harder with each loss. The authors explain that leverage reduces Kelly criterion dramatically. Optimal bet size drops as leverage increases. 2-to-1 leverage means Kelly allocations should be halved. Most leveraged investors ignore this. They use borrowed money to increase position sizes. This is mathematical suicide. Kelly violations plus leverage equal guaranteed ruin. Margin calls create forced selling. When portfolio drops, the broker demands more collateral. If you cannot provide it, they liquidate positions at worst possible time. This locks in losses permanently. Long-term capital management exemplifies leverage destruction. They had 25-to-1 leverage. Small market move decimated their capital. Brilliant minds could not save them. Leverage killed them. Haghani and White argue that leverage is almost never justified for individual investors. Expected returns do not justify increased ruin risk. Mathematics proves unlevered portfolios are superior long-term. But leverage is seductive. It promises faster wealth accumulation. Who wants to wait 40 years when leverage offers 20? The rush is intoxicating. The crashes are devastating. Consider mortgage leverage. Buying a home with 20% down creates 5-to-1 leverage. If home appreciates, returns are amplified. If home declines, you might owe more than home is worth. 2008 housing crisis showed mortgage leverage danger. Homeowners with negative equity lost everything. Foreclosures destroyed credit and lives. Leverage converted housing correction into personal catastrophe. The authors acknowledge leverage can work with permanent capital and time horizon. Businesses use leverage successfully because they have operating income and can wait out cycles. But individuals have neither advantage. You might need capital unexpectedly. Job loss, medical emergency, personal crisis. Leveraged positions force liquidation at losses. Unleveraged positions provide flexibility. Academic research supports unlevered portfolios. Risk-adjusted returns are higher without leverage. Expected returns do not compensate for ruin risk. This is mathematically proven. Psychological damage from leverage is severe. Watching leverage portfolio drop creates panic. Panic leads to poor decisions. Poor decisions lock in losses. Emotional spiral destroys wealth and well-being. Haghani and White share personal experiences. Colleagues who used leverage intelligently still faced enormous stress, sleepless nights, health problems, relationship strain. Financial stress radiates everywhere. The authors recommend zero leverage for most investors. If you insist on leverage, use minimal amounts, 1.2 to 1 maximum. Even this modest leverage increases risk significantly. Monitor leverage carefully. Calculate it explicitly. Include margin loans, portfolio loans, mortgages, business debt. Total leverage creates total risk. Hidden leverage is still leverage. Deleverage during good times. Resist the temptation to increase leverage when markets rise. This is when leverage is most dangerous. Leverage into strength, delever into weakness is backwards. The correct approach is opposite. Reduce leverage during bull markets. Maintain conservatism during manias. This protects against inevitable reversals. Missing Billionaires loved leverage. It amplified their early success. They increased leverage as wealth grew. They felt invincible. Then markets turned. Leverage destroyed them completely. Learn from their mistakes. Avoid leverage entirely. Build wealth slowly and safely. Unlevered compounding creates lasting fortunes. Leveraged speculation creates temporary gains and permanent losses. If you currently have leverage, reduce it immediately. Sell assets, repay loans. Accept lower returns in exchange for safety. Your future self will thank you. Leverage is seduction. Resist it. Choose boring safety over exciting danger. Boring approaches create extraordinary outcomes. Exciting approaches create missing billionaires. Chapter 6. Time Horizon and Compound Growth. Time is investors' greatest advantage. Long time horizons enable compounding. Compounding creates wealth reliably. Yet most investors think too short-term. Victor Haghani and James White emphasize that geometric returns determine long-term wealth. Arithmetic returns mislead. Volatility destroys geometric returns. Time horizon affects everything. Compound growth is exponential, not linear. Early years feel slow. Later years explode. Most people quit before explosion happens. Patience is competitive advantage. Consider two investors. Both start with $100,000. Both achieve 10% average annual returns. Investor A holds 40 years. Investor B holds 20 years. Investor A accumulates over $4,500,000. Investor B accumulates only $670,000. Same returns, dramatically different outcomes. Time created the difference. The mathematics is elegant. Wealth equals initial capital times 1 plus return raised to the power of years. The exponent creates exponential growth. Small changes in years create massive wealth differences. This is why starting early is crucial. 10 years earlier can mean millions more. Delay is expensive. Every year matters. Teenagers should invest. Parents should invest for children. But time horizon is not just age-related. It is psychological. Can you hold investments for decades? Most cannot. Impatience costs millions. Haghani and White discuss volatility drag. Volatile returns produce lower geometric returns than stable returns with the same arithmetic average. Volatility is enemy of compounding. An example makes this clear. Portfolio A gains 50% year 1, loses 30% year 2. The average return is 10%, but the geometric return is only 2%. Volatility destroyed returns. Portfolio B gains 10% year 1, 10% year 2. The average return is 10%. The geometric return is 10%. Stable returns preserved compounding power. This is why diversification and volatility reduction matter. Lower volatility increases geometric returns. Higher geometric returns produce dramatically more wealth over decades.
The authors emphasize that losses disproportionately hurt compounding. 50% loss requires 100% gain to recover. This is why downside protection is critical. Permanent loss of capital is catastrophic. It cannot be recovered through time. If you lose 90%, recovery is nearly impossible. protection against large losses is essential. Time horizon affects risk tolerance. Longer horizons allow accepting more volatility. Short horizons require safety. Match investments to time horizon. Money needed in 5 years should be safe. Bonds, savings, short-term instruments. Money not needed for 30 years can handle volatility. Stocks, real estate, alternatives. The biggest mistake is forcing yourself to sell due to time horizon mismatch. If bear market occurs when you need funds, you lock in losses. Proper matching prevents this tragedy. Haghani and White recommend multiple mental accounts. Retirement money is long-term. House down payment money is short-term. Segregate mentally and physically. This prevents mistakes. Tax efficiency compounds over time. Capital gains taxes are deferred until sale. Unrealized gains compound tax-free. This creates massive advantage. Buy and hold minimizes taxes. Frequent trading generates taxes annually. These taxes reduce compounding. Over decades, the difference is millions. Trading is expensive for this reason alone. The authors share research showing patient investors outperform active traders significantly, not because they pick better stocks, because they let compounding work uninterrupted. Interrupting compounding restarts the clock. Every sale and purchase creates transaction costs and taxes. These compound negatively. Minimizing interruptions maximizes wealth. Psychological challenge is boredom. Holding same investments for decades feels inactive. Humans crave action. Action destroys compounding. Overcome this impulse. Create rules that prevent premature selling. Never sell without written reasons. Require thesis breakdown before selling. Force yourself to justify sales. This reduces emotional selling. The missing billionaires lacked patience. They had winning strategies, but insufficient time horizon. They sold too early. They interrupted compounding. They chased new opportunities constantly. Wealth requires letting winners run for decades. Amazon, Microsoft, Apple created immense wealth for patient holders. Traders captured small gains. Holders captured life-changing gains. Implement long-term thinking today. Identify investments you can hold 20 years. Allocate significant capital to them. Then forget about them. Check annually only. Time is your friend. Compounding is your vehicle. Fuel is your patience. Combine these. Wealth is inevitable. Missing billionaires proved what not to do. Do opposite. Succeed. Chapter 7. Behavioral Biases in Wealth Management. Human psychology is poorly suited for investing. Evolution did not prepare us for financial markets. Understanding our biases is essential for overcoming them. Victor Haghani and James White identified T biases destroying wealth: overconfidence, recency bias, loss aversion, anchoring, confirmation bias. These are universal. No one is immune. Overconfident investors overestimate abilities. Studies show 90% of investors believe they are above average. This is mathematically impossible. Overconfident investors take too much risk. Overconfident investors trade too much. They use too much leverage. They concentrate positions excessively. They ignore warning signs. All these behaviors destroy wealth. The cure is humility. Assume you are average. Act accordingly. Diversify broadly. Size positions conservatively. This protects against overconfidence damage. Recency bias causes overweighting recent events. Recent bull market makes you too aggressive. Recent crash makes you too conservative. Both errors cost money. The solution is studying long-term history. Markets crash regularly. They also recover regularly. Long-term perspective prevents overreacting to recent events. Loss aversion means losses hurt more than equivalent gains feel good. This is hardwired. It made our ancestors cautious. In modern investing, it creates poor decisions. Loss aversion causes holding losers too long and selling winners too early. Investors want to avoid realizing losses. They want to lock in gains. Both instincts are backwards. Optimal strategy is opposite. Cut losses quickly. Let winners run indefinitely. This feels unnatural, but it is mathematically correct. Override instincts with rules. Anchoring makes us fixate on irrelevant numbers. Purchase price becomes anchor. We refuse to sell below it. But markets do not care what you paid. Only current value matters. Break free from anchors. Every day is new decision. Would you buy at current price? If no, sell. Past prices are irrelevant. This thinking improves decisions dramatically. Confirmation bias makes us seek supporting information and ignore contradicting information. We read bulls when we are bullish. We read bears when we are bearish. This reinforces existing views. Combat confirmation bias actively. If you are bullish, read bear cases. If you are bearish, read bull cases. Seek disconfirming evidence. This balances perspective. Haghani and White discuss herding. Humans are social. We follow crowds, but crowds are often wrong at extremes. Everyone bullish signals tops. Everyone bearish signals bottoms. Contrarian thinking is uncomfortable, but profitable. When everyone agrees, be skeptical. Consensus is usually wrong at turning points. Cultivate independence. Availability bias causes overweighting recent, vivid information. Recent market crash seems more important than historical average returns. Recent company scandal overshadows years of solid performance. Counter availability bias with statistical thinking. Base rates matter more than anecdotes. Data beats stories. Develop discipline to trust statistics over impressions. Mental accounting creates irrational behavior. People treat money differently based on source. Inheritance money is treated more conservatively than bonus money. This is illogical. Money is fungible. All dollars are equal. Treatment should be consistent. Overcome mental accounting through unified portfolio perspective. The authors emphasize that biases operate unconsciously. You can't eliminate them through awareness alone. You must create systems that override them. Implement rules-based investing. Written investment policy, predetermined entry and exit criteria, systematic rebalancing. These systems prevent bias-driven mistakes. Journaling improves decision quality. Write down reasoning before making decisions. Review later. This reveals biases operating in real time. Learning from documented decisions is powerful. Seek outside perspectives. Discuss investments with others. Different viewpoints reveal your blind spots. Isolation amplifies biases. Community corrects them.
Automate what you can. Automatic investment contributions. Automatic rebalancing. Automation removes emotion from process. It enforces discipline consistently. Haghani and White share that even experts suffer these biases. Knowledge does not eliminate them. Only systems and processes mitigate their impact. The Missing Billionaires were brilliant people who fell victim to behavioral biases. Intelligence provides no protection. Systematic approaches do. Study behavioral finance deeply. Read Kahneman's Thinking Fast and Slow. Understand how your mind works. Awareness combined with systems creates improvement. Practice bias recognition daily. Notice when you feel overconfident. Notice when recent events unduly influence you. Awareness is first step. Correction is second step. Accept that you will never eliminate biases completely. Goal is mitigation, not elimination. Reducing bias impact by 50% dramatically improves outcomes. Behavioral mastery separates good investors from great ones. Technical knowledge is common.
Psychological discipline is rare. Develop both. Become complete investor. Avoid behavioral destruction that creates missing billionaires. Chapter 8. The role of luck versus skill. Distinguishing luck from skill is critical. Attributing luck to skill creates overconfidence. Attributing skill to luck creates underconfidence. Both errors are costly. Victor Haghani and James White explain that investing involves enormous luck. Short-term results reflect luck more than skill. Long-term results reveal skill. Most people evaluate too quickly. 1 year of outperformance proves nothing. Random chance produces winners every year. Some coin flippers will flip heads 10 times consecutively. They are not skilled. They are lucky. Investing is similar. Some investors outperform through luck. They believe they are skilled. They increase risk. Eventually, luck reverses. They blow up. Misattribution destroyed them. The authors discuss Michael Mauboussin's framework, luck-skill spectrum, pure luck activities like roulette, pure skill activities like chess. Most activities, including investing, fall between. Investing contains substantial luck. Market returns are largely luck. Security selection adds skill. But even best security selection contains luck. Accepting this reality is wisdom. Research shows most active managers underperform indexes. After fees, 80% underperform over 15 years. This suggests luck dominates short-term. Skill might exist, but is overwhelmed by luck. The implication is humility. If you outperform, assume luck contributed significantly. Do not increase risk. Do not become overconfident. Gratitude and caution are appropriate responses. Haghani and White recommend analyzing process, not outcomes. Good processes produce good outcomes probabilistically, but short-term, bad outcomes happen. Judge yourself on process quality. Good decision with bad outcome is still good decision. Bad decision with good outcome is still bad decision. Separate process evaluation from outcome evaluation. This prevents overreacting to noise. If you made good decision and lost money, do not change process. If you made bad decision and made money, do not repeat process. The authors discuss outcome bias. We judge decisions based on outcomes, but this is logically wrong. Decision quality depends on information available when made, not subsequent results. Combat outcome bias through pre-commitment. Write down decision reasoning before knowing outcome. Compare later. This reveals decision quality independent of outcome. The role of luck increases with shorter time frames. Daily results are pure noise. Monthly results are mostly noise. Annual results contain significant noise. Multi-year results reveal skill. Yet most investors evaluate themselves annually. Even this is too frequent. 5-year periods are minimum for meaningful evaluation. 10 years are better. 20 years are ideal. Patience in self-evaluation is as important as patience in holding investments. Quick judgments produce wrong conclusions. Wrong conclusions produce bad adjustments. Bad adjustments destroy performance. Haghani and White emphasize that acknowledging luck is not defeatist, it is realistic. Realism improves decisions. Delusion creates disasters. Skill exists in investing. Risk management is skill. Position sizing is skill. Portfolio construction is skill. Emotional discipline is skill. Focus on developing these controllable skills. Security selection might involve skill, but luck dominates short-term. Process skills reduce risk and improve geometric returns. These skills matter long-term. The Missing Billionaires attributed luck to skill. Early success was lucky. They interpreted it as skill. They increased risk dramatically. Luck reversed. Skill could not save them. Learn from their mistake. When you succeed, stay humble. Assume luck played significant role. Maintain conservative risk management. This protects when luck reverses. When you fail, analyze process. Was process sound, but luck unfavorable? Maintain process. Was process flawed? Adjust process. Separate luck from skill in failure analysis too. Implement peer comparison carefully. Compare to appropriate benchmarks. Stock pickers should compare to stock indexes. Real estate investors should compare to real estate indexes. Fair comparison reveals skill contribution. But recognize that beating benchmarks is difficult. Efficient market hypothesis has merit. Most investors should accept market returns. Attempting outperformance often produces underperformance.
Index investing acknowledges luck's role. It accepts that skill is difficult to demonstrate consistently. It focuses on controlling costs and taxes. These are controllable factors. Security selection is not. The authors recommend that most investors use index funds. Add skill through asset allocation, rebalancing, and tax management. These provide better risk-adjusted returns than security selection. For those pursuing active management, establish clear evaluation framework. Define success metrics beforehand. Set appropriate time horizons. Evaluate honestly against predetermined criteria. Track your decisions systematically. Maintain decision journal. Record reasoning, expected outcomes, and actual results. Over time, patterns emerge. This reveals true skill level. Accept that luck will dominate your career. Even skilled investors experience long losing streaks. Warren Buffett underperformed for years during tech bubble. Skill eventually prevailed, but patience was required. Communicate honestly about luck. If you manage money for others, acknowledge luck's role. This builds trust. Clients respect honesty. They distrust those claiming certainty. Study probability and statistics. Understanding distributions, variance, and regression to mean improves luck skill assessment. Mathematical literacy separates sophisticated from naive investors. Remember that markets are complex, adaptive systems. Millions of participants, constantly evolving strategies, changing conditions. Predicting such systems is inherently difficult. Humility is rational response. The missing billionaires believed they had conquered luck. They had not. Luck is unconquerable. It is manageable through diversification and position sizing, but never eliminated. Accept luck's role. Focus on controllable factors, process, discipline, risk management. These create edge, not predicting specific outcomes, but managing portfolios intelligently. Your goal is not eliminating luck. It is surviving luck's downside while capturing upside. Proper risk management achieves this. Missing billionaires failed this fundamental requirement. Implement luck-aware investing today. Reduce position sizes, increase diversification, lower expectations, accept market returns. These approaches work with luck, not against it. Fighting luck is futile. Cooperating with luck through intelligent risk management is wise. This wisdom separates lasting success from temporary victory followed by catastrophic failure. Chapter 9. Asset Allocation and Portfolio Construction. Asset allocation determines 90% of portfolio returns. Security selection matters little compared to allocation decisions, yet investors obsess over stocks and ignore allocation. Victor Haghani and James White emphasize starting with strategic asset allocation. This is long-term target allocation across asset classes: stocks, bonds, real estate, alternatives, cash. Strategic allocation depends on goals, time horizon, and risk tolerance. Longer time horizon allows more stocks. Shorter horizon requires more bonds. Risk tolerance affects aggressiveness. The authors recommend writing investment policy statement. Define objectives clearly. State return requirements. Specify risk constraints. Document strategic allocation with ranges. For example, target allocation might be 60% stocks, 30% bonds, 10% alternatives. Ranges might be plus or minus 5%. This provides flexibility while maintaining discipline. Rebalancing enforces discipline. When stocks outperform, they exceed target allocation. Rebalancing sells stocks and buys bonds. This is selling high and buying low systematically. Annual rebalancing is generally sufficient. More frequent rebalancing generates transaction costs without significant benefit. Less frequent allows excessive drift. Annual balancing strikes appropriate balance. Threshold rebalancing is alternative approach. Rebalance when allocation drifts beyond predetermined threshold. For example, rebalance if stocks exceed 65% or fall below 55%. Haghani and White discuss optimal stock-bond allocation. This depends heavily on individual circumstances. No universal answer exists. Personalization is essential. Young investors with decades until retirement can allocate heavily to stocks, perhaps 80 to 90%. Time horizon allows weathering volatility. Equity premium compounds powerfully over decades. Middle-aged investors might allocate 60 to 70% to stocks. Time horizon is shorter, volatility tolerance may be lower. Balance between growth and stability is appropriate. Retirees might allocate 40 to 50% to stocks. Capital preservation becomes important. Income generation matters. Lower volatility reduces stress and sequence of returns risk. But these are generalizations. Individual circumstances vary. Someone with a pension might allocate more aggressively. Someone with concentrated business holdings might allocate more conservatively in portfolio. The authors emphasize considering total wealth, not just investment portfolio. Human capital is an asset. Future earnings are wealth. Young people have enormous human capital. This is a bond-like asset. Therefore, young people can allocate investment portfolios entirely to stocks. Their human capital provides bond-like stability. Total wealth is balanced even if the portfolio is aggressive. Geographic diversification within equities is important. U.S.-only allocation is home bias. International markets provide diversification. Developed and emerging markets have different return drivers. Reasonable allocation might be 60% U.S. stocks, 30% international developed, 10% emerging. This provides global diversification while maintaining U.S. preference. Within bonds, consider duration and credit quality. Short-term bonds have less interest rate risk. Long-term bonds provide higher yields and equity diversification during crises. In-grade bonds are safer. High-yield bonds offer higher returns but more risk. Mix depends on overall portfolio risk. Conservative portfolios emphasize in-grade. Aggressive portfolios can include high
Alternative
yield.
investments include real estate, commodities, private equity, hedge funds. These provide diversification from traditional stocks and bonds. Correlation is key benefit. Real estate investment trusts provide liquid real estate exposure. Commodities hedge inflation. Private equity offers illiquidity premium. Hedge funds provide uncorrelated returns, at least theoretically. But alternatives had limitations: higher fees, lower liquidity, less transparency, complexity. Most investors should limit alternatives to 10 to 20% maximum. Haghani and White warn against complexity for complexity's sake. Simple portfolios of index funds outperform complex portfolios of actively managed alternatives. Complexity adds cost without adding value. The Missing Billionaires often had overly complex portfolios. Dozens of positions, multiple strategies, overlapping exposures. Complexity obscured risk. Simplicity would have saved them. Implement simple, diversified allocation. Total Market Stock Index, Total Bond Market Index, International Stock Index, perhaps REIT Index. 4 funds provide complete diversification. Tax location optimization increases after-tax returns. Hold tax-inefficient assets like bonds in retirement accounts. Hold tax-efficient assets like index funds in taxable accounts.
Municipal bonds make sense for high-income investors in taxable accounts. Tax-free interest exceeds after-tax yield of corporate bonds. Know your tax bracket. Optimize accordingly. Rebalancing generates taxes in taxable accounts. Use new contributions to rebalance first. This avoids triggering capital gains. Sell only when drift is excessive or contributions are insufficient. Review allocation annually. Circumstances change. Goals evolve. Risk tolerance shifts. Adjust strategic allocation as appropriate, but avoid frequent changes. Stability is valuable. The authors emphasize that asset allocation is personal. Financial advisor recommendations must be customized. Generic advice is worthless. Spend time defining your unique circumstances. Document decisions. Write down why you chose specific allocation. Future you will question past decisions. Documentation provides rationale. This prevents emotional changes during market stress. Asset allocation is not exciting. It does not generate dinner party stories, but it determines success. Master allocation. Worry less about security selection. This priority creates wealth. Missing Billionaires picked great investments with terrible allocation. Concentration in single asset class destroyed diversification benefits. Allocation would have saved them. Learn this lesson. Chapter 10. Tax Efficiency in Wealth Building. Taxes are largest expense most investors face. Minimizing taxes dramatically increases wealth, yet tax planning receives insufficient attention. This is a costly mistake. Victor Haghani and James White calculate that taxes reduce returns by 1 to 3% annually for typical investor. Over 40 years, this reduces wealth by 40 to 70%. Tax efficiency is therefore critical. Small improvements compound enormously. Strategies that save 1% annually add millions over lifetimes. The authors explain that tax-deferred accounts are most powerful tool. 401k, IRA, 403b allow contributions to grow tax-free until withdrawal. Decades of tax-free compounding create massive advantages. Maximum contributions to tax-deferred accounts should be priority. For 2025, 401k limit is $23,000. Those over 50 can contribute an additional $7,500. Max out these limits. Traditional versus Roth is common question. Traditional provides upfront tax deduction. Roth provides tax-free withdrawals. Choice depends on current versus future tax rates. If current tax rate is high and you expect lower rates in retirement, use traditional. If current rate is low and you expect higher rates later, use Roth. Uncertainty suggests splitting between both. Tax loss harvesting generates tax deductions. Sell losing investments to realize losses. These offset gains and up to $3,000 of ordinary income annually. Excess losses carry forward indefinitely. Immediately repurchase similar but not identical investment. This maintains market exposure while capturing the tax benefit. For example, sell S&P 500 index fund, buy total market index fund. Wash sale rule prevents repurchasing the same security within 30 days. Violating this rule disallows loss. Be careful with wash sales. Use similar but different securities. Haghani and White recommend direct indexing for wealthy investors. Own individual stocks instead of index funds. This enables tax loss harvesting at individual security level. Direct indexing can generate 3 to 5% annual tax losses even in rising markets. Some stocks decline while index rises. Harvest these losses. Repurchase similar stocks. Maintain market exposure. Asset location optimization places tax-inefficient assets in tax-deferred accounts. Bonds, REITs, and actively managed funds generate ordinary income and short-term gains. Shield these from taxes.
place tax-efficient investments in taxable accounts. Index funds, individual stocks held long-term, generate qualified dividends and long-term capital gains. These tax rates are lower. Minimize turnover in taxable accounts. Every sale triggers taxes. Buy and hold defers taxes indefinitely. Unrealized gains compound tax-free. This creates enormous advantage over frequent trading. Capital gains step-up at death eliminates taxes on lifetime gains. Heirs receive assets at fair market value on death date. Appreciation during your lifetime disappears for tax purposes. This makes never selling highly appreciated assets in taxable accounts optimal. Hold until death. Heirs inherit tax-free. Lifetime of gains escape taxation completely. Charitable giving is tax-efficient for appreciated assets. Donate stock directly to charity. Receive deduction for full market value. Avoid capital gains tax. Charity receives full value. Never sell appreciated stock to donate cash. This triggers unnecessary taxes. Direct donation of stock is superior. Most charities accept stock donations easily. Qualified charitable distributions from IRAs benefit retirees. After age 70, you can donate up to $100,000 annually from an IRA directly to charity. This satisfies required minimum distribution without increasing taxable income. Haghani and White discuss tax gain harvesting, opposite of tax loss harvesting. Intentionally realize gains when tax rate is low, resets cost basis higher, reduces future taxes. This makes sense for low-income years, partial retirement, sabbatical, early retirement before Social Security. Realize gains at 0 or 15% rate. Repurchase immediately. No waiting period for gains. Estate planning minimizes estate taxes. Federal exemption is high, over $13 million per person in 2025. But state exemptions vary. Some states have low thresholds.
Reduces taxable estate. Annual exclusion is $19,000 per recipient. Gift to children, grandchildren, anyone. This removes assets from estate tax-free. Trusts provide additional estate planning tools. Irrevocable trusts remove assets from estate. Grantor-retained annuity trusts transfer appreciation tax efficiently. Consult estate planning attorney for complex situations. The missing billionaires often ignored tax planning. They focused entirely on pre-tax returns. After-tax returns determine actual wealth. Neglecting taxes destroyed significant value. Implement tax strategies immediately. Max retirement contributions. Harvest tax losses. Optimize asset location. Minimize turnover. These simple steps save enormous money. Work with qualified tax advisor. Tax law is complex. Professional guidance prevents costly mistakes. Good advisors pay for themselves many times over through tax savings. Track your tax burden. Calculate effective tax rate on investment income. Monitor how strategies reduce taxes. Measurement motivates continued optimization. Remember that tax efficiency compounds over lifetimes. 1% saved annually becomes millions saved over 40 years. Tax planning is not optional for serious wealth building. Chapter 11. Protecting wealth from catastrophic risks. Building wealth requires decades. Protecting wealth requires constant vigilance. Catastrophic risks can destroy everything quickly. Insurance and hedging are essential. Victor Haghani and James White emphasize that tail risk protection is critical. Extreme events occur more frequently than normal distributions predict. Fat tails mean occasional catastrophes. Prepare for them. Life insurance protects dependents against income loss. If you have people relying on your income, life insurance is mandatory. Term life insurance is simple and cheap. Buy coverage equal to 10 to 20 times annual expenses.
Whole life insurance combines insurance and investment, generally inferior to buying term and investing difference. Exception might be for estate planning in high net worth situations. Disability insurance is often overlooked. You are more likely to become disabled than die during working years. Disability insurance replaces income if you cannot work. Priority purchase for high earners. Umbrella liability insurance protects against lawsuits. Covers amounts exceeding auto and homeowner liability limits. Relatively cheap, $1 to $5 million coverage costs few $100s annually. Everyone should have umbrella policy. Property and casualty insurance protects homes, vehicles, and possessions. Adequate coverage is essential. Do not underinsure to save premiums. Proper coverage prevents catastrophic loss. The authors discuss investment portfolio protection. Diversification is first line of defense, but diversification fails during extreme events. Additional protection is needed. Long-term bonds historically rally during stock crashes. Negative correlation provides diversification. 60-40 stock-bond portfolio is more stable than 100% stocks. Put options provide insurance against market crashes. Buy out-of-money puts on index funds. If the market crashes, puts appreciate significantly. This offsets portfolio losses. But puts are expensive. They decay over time. Continuous protection costs several percent annually. This reduces long-term returns significantly. Trade-offs must be considered. Haghani and White recommend tail risk hedging only for large portfolios where catastrophic loss is truly ruinous. Most investors better served by diversification and appropriate stock-bond allocation. Emergency fund is essential protection. 6 to 12 months expenses in cash or short-term bonds. This prevents forced selling during market crashes or job loss. Emergency fund seems inefficient. Cash earns little, but option value is enormous. Having cash during a crisis is priceless. Everyone needs emergency fund, regardless of wealth level. Avoid concentrated positions in single stock. Company-specific risk is enormous. Enron, Lehman Brothers, countless others went to zero. Diversify individual stock holdings aggressively. Employees with stock options or restricted stock face concentration risk. Diversify as soon as possible. Do not let company stock exceed 10% of net worth. Loyalty is admirable. Concentration is dangerous. Hedging strategies for concentrated positions include protective puts, collars, and exchange funds. These techniques reduce risk while maintaining some exposure. Wealthy individuals use these extensively. Geopolitical diversification protects against country-specific risks. Do not keep all assets in one country. Currency crisis, property seizure, regulatory changes can destroy domestic-only wealth. International investments, foreign bank accounts, offshore trusts provide geopolitical diversification. Complex and expensive, but worthwhile for substantial wealth. Consult international tax and legal experts. The authors emphasize that catastrophic thinking seems paranoid. Most years, insurance and hedging cost money without benefit, but rare catastrophic years make everything worthwhile. Fat tail events are underestimated systematically. Black swans happen regularly. 1987 crash, 2000 tech bubble, 2008 financial crisis, 2020 pandemic crash. Major events occur every 5 to 10 years. Preparation for these events is rational, not paranoid. Insurance costs money during calm periods, but it saves fortunes during storms. Think probabilistically about tail risks. Missing billionaires often lacked basic protection. No diversification, no emergency funds, leverage portfolios. When catastrophe struck, they had no defense. Complete destruction followed.
Implement protection immediately. Review insurance coverage. Build emergency fund. Diversify aggressively. Reduce leverage. These actions provide safety. Sleep well at night. Knowing you are protected from catastrophe provides peace of mind. This psychological benefit is valuable beyond financial calculation. Remember that wealth preservation is as important as wealth creation. Defense wins championships. Protection prevents missing billionaire status. Prioritize safety appropriately. Chapter 12. Building a comprehensive wealth plan. Everything discussed must integrate into a comprehensive plan. Isolated strategies without overall framework produce suboptimal results. Comprehensive planning optimizes outcomes. Victor Haghani and James White provide a framework for a complete wealth plan. Start with clear goals. Quantify them: retirement spending, legacy intentions, philanthropic desires. Specific numbers drive planning. Calculate required return to achieve goals. Current wealth plus future savings growing at X% must equal future goals. Solve for X. This is required return.
Required return to reasonable expectations. If you need 12% but markets provide 8%, you have problem. Either increase savings, reduce goals, or accept shortfall risk. Monte Carlo simulation adds sophistication. Model thousands of scenarios with varying returns, inflation, life expectancy. Calculate probability of success. Aim for 80 to 90% success rate. Lower probability indicates insufficient resources or excessive goals. Adjust plan accordingly. Increase savings. Reduce spending targets. Work longer, some combination. Document asset allocation supporting goals. Strategic allocation with ranges. Rebalancing policy. Expected returns and volatility for each asset class. This becomes blueprint. Create implementation plan. Which accounts hold which assets. Tax location strategy. Dollar cost averaging schedule. Rebalancing dates. Specific action items with deadlines. Establish risk management framework. Insurance needs. Emergency fund target. Position size limits. Maximum drawdown tolerance. These protect against catastrophic outcomes. Tax strategy integration is critical. Contribution limits for retirement accounts. Tax loss harvesting schedule. Roth conversion timing. Charitable giving plan. Taxes significantly impact wealth accumulation. Estate plan documents everything: will, trusts if appropriate, beneficiary designations, powers of attorney, healthcare directives, legal structure ensuring wishes are executed. Haghani and White emphasize regular reviews, annual minimum. Major life changes demand immediate review. Marriage, divorce, children, inheritance, job change, all affect plan. Track performance against benchmarks. Are you on track for goals? Is allocation appropriate? Are risks managed properly? Measurement enables adjustment. Ignorance enables disaster. Adjust plan as circumstances evolve. Flexibility is essential. Rigid plans fail when life changes. Regular updates maintain relevance. Review and revise consistently. The authors discuss working with professionals. Financial planner creates comprehensive plan. Investment advisor implements investment strategy. Tax accountant optimizes taxes. Estate attorney creates legal documents. Choose professionals carefully. Fiduciary standard is mandatory. Fee-only advisors avoid conflicts of interest. Check credentials. Certified financial planner, chartered financial analyst, certified public accountant are legitimate. Avoid commission-based advisors. Commissions create conflicts. They recommend products benefiting them, not you. Fee-only alignment interests properly. Understand fees completely. Advisory fees, fund expenses, trading costs, tax costs, all reduce returns. 1% annual fee costs hundreds of thousands over lifetime. Minimize fees aggressively. Low-cost index funds are default choice. Active management rarely justifies higher fees. Exception might be specialized areas like small-cap value or emerging markets. Adopt, automate what you can.
automatic contributions, automatic rebalancing. Automation removes emotion and ensures consistency. Set systems and forget them. Behavioral coaching is valuable professional service. Good advisors prevent emotional mistakes during market volatility. This value often exceeds investment expertise. Find an advisor who will stop you from panicking. Document everything: investment policy statement, financial plan, meeting notes, track record. Documentation provides accountability. It also provides continuity if advisors change. Haghani and White share that comprehensive planning distinguishes successful from unsuccessful investors. Random actions produce random results. Systematic approaches produce consistent results. The Missing Billionaires lacked comprehensive plans. They had pieces, but not integration. Investment strategy without risk management failed. Returns without tax planning left money on the table. Implement comprehensive planning today. Start with goals, calculate requirements, design allocation, establish risk management, create implementation plan, review regularly. This process requires time. Do not rush. Thoughtful planning pays for itself many times over. Hasty planning creates problems later. Consider planning as an iterative process. First version will not be perfect. Refine over time. Each review cycle improves plan quality. Continuous improvement is goal. Remember that planning provides confidence. When markets crash, your plan guides you. When opportunities arise, your plan informs decisions. Structure provides stability. Comprehensive planning is what successful investors do. Missing Billionaires skipped this step. Learn from their mistake. Plan comprehensively, implement systematically, review regularly, succeed consistently. You now understand why billionaires are missing. Poor decision-making destroys wealth that should exist. Mathematics and discipline create wealth that does exist. Victor Haghani and James White provided framework for superior financial decisions: expected value thinking, Kelly criterion, diversification, leverage avoidance, tax efficiency, risk management, comprehensive planning. These principles are not complex. They are simple, but not easy. Implementation requires discipline. Discipline requires systems. Systems require commitment. Start today with one principle. Calculate Kelly sizing for current portfolio. Rebalance to appropriate allocations. Reduce leverage to zero. Choose one action. Execute it immediately. Small improvements compound enormously. 1% better decisions annually become transformative over decades. Continuous improvement is sustainable path to wealth. Avoid missing billionaire traps: overconfidence, excessive leverage, poor diversification, inadequate risk management. These destroy fortunes reliably. Recognition is protection. Embrace mathematics over emotion. Feelings mislead in financial decisions. Numbers guide correctly. Trust mathematics. Override instincts when they conflict. Accept that wealth building is slow, decades, not years. Compounding requires patience. Shortcuts are myths. Sustainable wealth is built systematically over time. Learn continuously. Financial markets evolve. Strategies adapt. Your education never ends. Readers become leaders. Learners become earners. Network with like-minded people. Community accelerates learning. Discussion improves thinking. Isolation creates blind spots. Build relationships with people on similar journey. Stay humble before markets. Overconfidence precedes destruction. Respect risk constantly. Markets humble everyone eventually. Humility is survival strategy. Celebrate progress appropriately. Acknowledge milestones. Appreciate growth. Gratitude increases happiness. Success without appreciation feels empty. Remember your purpose. Money is tool, not goal. Build wealth to create freedom. Freedom enables pursuing what matters. Keep perspective always. Give back generously. Share knowledge. Help others avoid mistakes. Contribution creates meaning beyond accumulation. Legacy is what you give, not what you keep. The Missing Billionaires made preventable mistakes. You will not. You understand the principles, you have the framework,
You possess the knowledge. Implementation determines outcomes. Knowledge without action produces nothing. Take action today. Start small, build consistently, progress compounds. Thank you for investing time in financial education. Apply these principles immediately. Transform your financial future, build wealth that lasts. Your financial journey continues now, armed with knowledge, guided by mathematics, protected by discipline. Success is inevitable for those who follow these principles. Become the billionaire who is not missing. Through intelligent decisions, systematic implementation, patient compounding, your financial future starts now.